Alright guys, let's talk about something that might sound surprising at first. Costco, yes, the same Costco where millions of Americans stock up on groceries and essentials, is quietly flashing warning signs about the US economy. And here's why this matters. With about 1/3 of its sales tied directly to imported goods, Costco often sees global disruptions and consumer behavior shifts long before they fully show up in your neighborhood or even in official government data. What the company just told investors isn't just about bulk groceries or household items. It's about broader consumer confidence, recession risk, and yes, even the housing market. Because when you look carefully at what Costco's executives revealed, you'll see connections to real estate trends that could either destroy the value of your home or create one of the biggest real estate buying opportunities in more than a decade. And here's the key. Most analysts aren't talking about these connections yet. But by the end of this video, I'm going to show you the data, the trends, and even the regions where institutional money is moving in, and where inventory is building so fast that prices are correcting right now. So let's start with what Costco's leadership revealed. CEO Ron Vakras explained that the company has been accelerating orders ahead of potential tariff increases and even rerouting supply chains to avoid bottlenecks. Now, that sounds like typical corporate planning. But the detail that caught analysts' attention was this. Costco is being extremely deliberate about which price increases to absorb and which ones to pass through to customers. For example, they're keeping staples like produce and dairy stable, while allowing certain discretionary items, electronics, seasonal goods, to rise. That's a clear sign that they're laser-focused on how sensitive their customers are to price changes right now, and this is where the bigger connection comes in. When bulk shoppers, the people who already go out of their way to save money, start shifting how they buy groceries, it tells us something very important. It signals that consumers across the board are becoming cautious. And historically, when that happens, it doesn't stop at groceries. It spills over into cars, major appliances, and yes, real estate. Now, let's tie this into the broader economy. The Conference Board's Consumer Expectations Index, which tracks how optimistic or pessimistic households are about the future, came in at just 74.4 in July 2025. That's the 6th month in a row it's stayed below 80. Why does that matter? Because historically, readings below 80 correlate with recession risk. And it's not just a survey number. Other polls show that more than 60% of Americans believe a recession is coming within the next year. When families feel that level of uncertainty, they delay big purchases. And what's bigger than buying a house? That's why Costco's signals about consumers trading down, from premium proteins to ground beef and poultry, from restaurants back to home cooking, are so important. If families are cutting back at Costco, they're almost certainly not rushing to stretch their budgets on a new home. Now let's connect this directly to the housing market data. The United States currently has over 1.1 million homes for sale, according to Realtor.com, marking the 3rd straight month above the 1 million mark and the 21st consecutive month of rising inventory. That's a massive shift compared to just 2 years ago when inventory was at record lows. And homes are now taking about a week longer to sell compared to last year. But here's the critical part. This inventory surge is not uniform across the country. In some regions, it's exploding. In others, it's still tight. And that's why national averages can be misleading. You need to understand the regional breakdown. In July, Realtor.com data showed that 33 of the 50 largest U.S. metros saw year-over-year price declines. That means 2/3 of major American cities are actually cheaper today than they were a year ago. For example, Austin prices were down nearly 5%. Miami saw a decline of about 4.7%. Chicago, down 4.4%. These aren't catastrophic crashes, but they are clear signs of weakening momentum. Nationally, about 1 in 5 home listings saw a price reduction in July. That's still historically high, even if slightly lower than earlier months. And again, some metros are leading the charge. Western markets and fast-growth Sunbelt cities that boomed during the pandemic are now giving back ground. Let's break it down regionally. The West saw active listings jump over 32% year-over-year. The South followed with about 25% growth. The Midwest was up 18%. The Northeast rose just 15%. That means buyer opportunities look very different depending on where you live. In the South and West, inventory is building, and sellers are cutting prices. In the Northeast and Midwest, supply remains tighter, keeping prices more resilient. Now let's layer in mortgage rates. In early July, the average 30-year fixed rate sat around 6.8%, brushing against the 7% threshold that historically dampens buyer activity. Industry forecasts expect rates to remain between 6 and 7% for the rest of 2025. And here's a key dynamic. Many homeowners are locked in at lower rates from a few years ago. Research suggests the vast majority would face a significantly higher payment if they sold and bought again. That lock-in effect is keeping some inventory off the market, but economic pressures, job changes, downsizing, relocations are still forcing others to list, especially in more volatile regions. On the affordability side, the National Association of Realtors reported that the median existing home price hit about $435,000 in June, the highest on record. And while prices remain high, cash buyers are increasingly dominating. Nearly 3 in 10 home purchases are now made in cash, well above historical norms. That gives wealthy buyers and institutional investors a huge advantage, while first-time buyers relying on financing are struggling to compete. Another shift, the age of the typical buyer is climbing. Decades ago, first-time buyers were often in their late 20s. Today, the median is well into the 40s and 50s, and homes priced above $1 million have actually seen stronger activity than lower price tiers, showing how divided the market has become between those with capital and those without. Now, let's look at the job market, because housing demand always tracks closely with employment. July's job growth came in below expectations, and while overall unemployment remains relatively low, long-term unemployment, those out of work for 27 weeks or more, has started to climb again. That adds another layer of caution, especially for first-time buyers who rely on steady employment for mortgage approval. And it's not just Costco signaling this consumer caution. McDonald's, for example, reported weaker traffic in recent months, showing that more people are cutting back on restaurant visits and focusing spending on food at home. These patterns align with Costco's own reports. Households are making trade-offs, and when that happens, housing decisions often get delayed. So, what does all this mean for the real estate market going forward? Let's break it into regions. Pacific Northwest, Seattle, Portland. Seattle remains relatively strong, supported by tech jobs and limited supply, though Portland shows signs of softening. The Northeast, more stable overall with less inventory growth and modest pricing shifts. The Midwest, attracting attention from institutional investors due to affordability and steady employment bases. The South and Sunbelt. This is where the biggest corrections are happening. Cities like Austin, Phoenix, and parts of Florida that saw massive pandemic-era price booms are now facing growing inventory and downward pressure on prices. California. Still resilient in prime areas, but affordability is stretched to the limit. In San Francisco, for example, a new buyer would pay hundreds more per month compared to existing owners, discouraging turnover. For buyers, this environment creates opportunities. If you have cash or strong financing, markets with high inventory growth and more price cuts, especially in the South and West, offer better negotiating power. For sellers, it means pricing realistically and moving quickly is more important than ever. For investors, it means strategy matters. Some regions still offer stability, while others may present value opportunities after corrections. And don't forget, real estate isn't the only play. Institutional capital continues to flow into our REITs tied to industrial and data centers, boosted by the AI and e-commerce boom. That's another signal of how capital is chasing stability in uncertain times. So, here's the takeaway. Costco isn't just selling groceries. It's giving us a real-time window into consumer psychology. And right now, that psychology is cautious. Families are trading down on food. They're delaying discretionary spending. And that caution is already rippling into the housing market. The U.S. is in a transition period. Some markets are cooling fast. Others remain hot due to supply constraints or strong local economies. But the national story is clear. Inventory is rising, price momentum is shifting, and consumer confidence is weak. That doesn't mean disaster. Market cycles always create winners and losers. But it does mean that understanding your local conditions, your region's inventory, employment base, and demand is more important than ever. So, let me leave you with this question. What are you noticing in your local market? Are homes sitting longer? Are sellers cutting prices? Or is demand still strong where you live? Because whether you're buying, selling, or investing, connecting the dots between consumer behavior, corporate signals, and local housing data will put you ahead of the curve. If you found this video helpful, make sure you hit that like button, subscribe, and turn on notifications. We'll keep bringing you the data, the insights, and the trends that help you make smarter decisions in uncertain times. Thanks for watching, and I'll see you in the next one.